This is Tom Ashby with the Viper Report Market Wrap video released on December 22nd. Well, last Wednesday's plunge in the market caught many by surprise, and even though the S&P and Dow and NASDAQ Composite all rebounded around 1% on Friday, it was still a rough week. S&P was down 1.8%, NASDAQ 100 2.2%, and the common stock, as represented by the New York Composite, was down over 3%. Let's look at some charts. The weekly chart of the Spider Trust shows that it had a good-sized tail. It had a low just above 580, and then managed to close at 590.83. You can see the 20-period EMA at 578, and many are watching the key support around the 5,800 to 5,850 area. If it is violated, you can see we have these twin lows back from early in November. They're in the 567, 568 area, and then more important here, that goes back to July, which the high was 565. Last week the AD line did drop below its moving average. Okay, so, and more negative numbers in the advanced decline this week, so it's still declining, getting back to support here, and between that high and this low. So the weekly analysis on pretty much all the major averages except the NASDAQ 100 is negative, but typically before a more significant top, we would expect to see some divergences and more top building. We don't see that yet. So, we would look for the AD line to rebound back above its moving average, maybe not before the end of the year, but early in 2025. You can see from the market roundup, we closed at 590.83. That's down 1.2% below its 20-day EMA. Weekly and daily AD lines are negative. Only two are positive. That's the QQQ. Weekly is positive. Daily is not. You can see the QQQ closed just below its 20-day EMA. The biggest gap is with the Russell, 4.2%, and the Dow and New York Composite are 2 and 2.8%. The Dow Industrials AD line has dropped back to its moving average, but has not yet crossed below it. This chart of the NYSE Composite shows you the close was well below its 20-week EMA, which is at 19,392. So it hasn't been below it one other time significantly, and that was in the July lows. So it's getting down into some pretty good support, going back to these twin peaks here, in the September, or in the rather July highs. You can see the NYSE stocks only AD line has dropped below its moving average. Moving average is flattening out here. Okay, similar sort of thing for the NYSE all, as it's starting to act a little weaker in my view than the stocks only. Stocks had held up quite well for a good part of the last couple of weeks, and the tip-off from our view was in the QQQs. Its AD line had made new highs going into early December, started to falter here, and you can see it got hit hard on Wednesday with a range of about 537 on the upside down to 515. We're getting right back into the November highs and the pivot around 503, and if you go back to the July high, that was also in that 500 area. AD line is negative on the Qs. It had been positive, as I said, up till the start of the week, and it's turned up here. A lot of people are saying, okay, that was it, and it's possible that that's the case. To me, we'll go through the charts. I don't see enough evidence to suggest we're just going to have a V-shaped bottom and go higher again. What I think is more likely, and of course the Qs are the market leaders, so if anything's going to be the strongest, it'll be it, is we could get a bit more of a bounce up to the declining EMA for the NASDAQ 100 AD line and then turn down. And that would allow for some backing and filling. May not go a lot below last week's lows or Friday's lows, but take some time before the moving average can flatten out and then start to turn higher. You can see in the percent chart here, also it's the fact that most of the averages closed well below the highs. For example, S&P hit 59.82 for a high on Friday, closed at 59.30, so 50 points off the highs. You can see down below here we have that 77.8% of the S&P stocks closed above or positive on Friday. That's a pretty good number. That's one of the evidence that suggests that could be a turn. We've seen similar times when we've seen such a big number, as the rally has resumed back in September. Small cap, 45%, not as impressive, and 58% in the QQQ. You can see we had this peak 90% down day on Wednesday, and back in August we got a rally off of there, and within about a week or so things did turn around. So that's just possible this time, but I usually keep my powder dry until the AD lines give me a clear signal that the uptrend has resumed. The high-low analysis is negative. You can see we set a sharp surge in the NYSE new lows to about 250, well above the August high. And of course, we only had 25 new highs on Friday. Quite a spread. NASDAQ Composite, similar. We made it above 300 last week, and a pattern of higher highs here is a negative and suggests that the momentum is on the downside despite Friday's gains. There was a big move higher in the VIX on Wednesday. We got up to, I think, 28, dropped sharply back to 18. So that was a big reversal. Some traders follow that big move after a spike high is a buy signal. You can see both, and the VX and also hit slightly above 27.50, now back to 21. So it's also dropped 20% from its high. My experience, I'd rather see it, complete a more compelling top formation, that it could do by, bouncing a little bit early in the week and then dropping back below its moving average that would flatten out. So it's kind of a wait and see for me on that. Put call ratio, spiked a little bit, last week, but not really, 130 on the index put call. So that's just 30% more puts than calls. And so we'll be watching these to see whether, they continue to start a new uptrend. That would be more bearish for stocks, or if they just drop back, into the 0.80 area for the total put call ratio. This 260 chart shows you the plunge on Wednesday and slight bounce, and then more new lows early Friday. We got down to, I think about 577.74, and then rebounded back up as high as 596. So in terms of fib resistance, we pretty much hit everything except 61.8%, which is at 597. Depending on how stocks open tonight overseas, we could see a push above that level. I'm not sure I would chase it even if that does occur. More likely we're going to see some, profit taking, in that 600, up to 610 area. So I would wait for a pullback closer, to the 20 period EMAs before I'd get too excited about the long side. That and some really strong advanced decline numbers. You can see that the rebound in the QQQs was quite sharp also, but not quite as sharp. So made it up to 525 here. Held above the 38% support. That goes back, to the lows we made in September. So, that may be all it takes. We've been watching the 500 level. We broke this short-term uptrend, much stronger down in here, and lots of good support, between about 498 to 500. And based on its RS analysis, it is still leading the market. The Friday's PCE report, the Fed's favored inflation gate, didn't show any big surprises. You can see the chart of the 10-year note yield has surged above the prior peak, reaffirming the uptrend. We had some pretty clear topping signs in early November, and those often lead to a more substantial decline than what we got. Roughly, went about from about 4.496, down and held, above 4.12. So the daily MACDs have turned back around. So we're up above the Stark band. So, of course, right now we're extended. So that does allow for a pullback in yields early in the coming week. Of course, holiday shortened week. So it'll be interesting to see how yields act if they get down, to the 4.40 area. Since I'm a bit under the weather this weekend, possibly thanks to a late Christmas party, we'll be cutting the report a bit short, but I don't think I'll leave anything out. There were some significant changes in the watch list this week, and I don't think they go to my view that I don't think a low is in place right now. That could be easily disproven if we see a couple of strong up days early in the week ahead. More likely we could see some more buying on Monday and then some more profit taking. Now only 49.6% of the ETFs closed above the pivots, 64.2 last week. That's quite a significant change. There were 5 new positive signals, all in inverse bond and stock ETFs. 26 new sell signals in everything from in the Russell, Diamond, XLP, and VIS, which is the Vanguard materials, or industrials rather. For growth, 80% are above their quarter pivots with 70% positive weekly, but 0% positive daily. Value, only 18.2%. Of course, value was hit the hardest last week, and 0 positive DTS that way also. So, leveraged longs, are still holding up pretty good, but the short ETFs, have generated 100% daily signals, and also, are starting to look like. If you look at the chart of the futures, you can see the big down bar here, and you can see there's major support down at this level, which is at 57.79, and 61.34 is the pivot for the weekend ahead. So that's where any rally should probably falter. From the overall, it was pretty bad. So XLK 58.3 and XLC are the only two that are 50 or higher. XLF, dropped from 81.8% down to 45.5, and XLY, another strong ETF, dropped to 41.7. And 3 of them have 0, with XLU at 8.3. So typically when you see that sort of extreme, its components are not going to turn around right away and go back up. I mean, anything is possible, and you never say always or you ever say never, but it would take some very powerful buying at the start of the week to kick things that much into positive territory. As I said before, SPY was down 1.8, QQQ was down 1.2, and so a lot of trends here are negative. In other words, they've dropped to 50, like XLU is 8.3, and some of the stronger ones, XLF, we're going to have to watch on the rally. It's getting below 50, and not too many good hiding places here based on this analysis. Looking at the sector ETF report, lots of red, not much green, and you can see, the 3-day DTS, at the top, consumer discretion, consumer staples, financials, SPY, and the Vanguard small cap, XIJ, all negative. And if you look down here, oil and gas is doing poorly as well. Lots of pretty much solid red from the bottom part of that report. SMH did close the week with a positive 3 DTS, but sort of a choppy chart. So we're watching it, but have no recommendations there at this point. You can see the cells here: KRE, IWM, FXR, healthcare, IPO ETF, KBE. So both the bank ETFs are now negative. Junk bonds also negative. Mid caps, pretty much a lot of the key markets. The pure value, the RPV also was hit pretty good. So, and we were stopped out of our VTV, our Vanguard value. Got out above where we got in, but still it had quite a good size price erosion, which we don't like to see. We'll look at the sector report and then call it a day. You can see, looking at the RS plots, energy, materials, industrials, all look pretty lousy. Consumer discretionary, it did pull back as we noted, but still a nice trend there in the RS. Consumer staples, it looked like it may have been trying to bottom here, but now it really needs to get above the November peak to turn it around. Healthcare, a solid downtrend. This is where this can really be important to you. If you got in, did any buying in healthcare in the last couple of months, really since July, we did not, fortunately. You can see this chart will tell you that why those positions haven't done well. So this tells you that the slow moving average, is below the fast moving average, in light green rather, is below the slow moving and in a clear downtrend. Financial, it's also in the corrective mode. So given what happened to the banks when they crossed here, I thought it was going to be a minor blip, but it's persisted. Technology is positive. Communications services, positive. Utilities and REITs, XLRE, are both negative. Well, that's all I have for today. On the Viper Report, you can find several articles about relative performance. That's how you find the next bull market leaders. Those of you who following me since the last 10, 15 years know that that's really a unique ability. In the 2007, 2008 bear market, it was caused by the financial stocks. The relative performance topped out in late 2006, giving you advance warnings that you should get out of the banks. Things like, I think Bank of America went from over 50 to around $5 a share. So lots to read there. Hope you all have a nice Christmas holiday with family and friends, and we'll keep you posted. I may be traveling next weekend, and if so, there won't be a video. Thank you very much.